Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is March 28th, 2025. Let's jump right in and dive into what's been happening across the markets.
First, let's start with a quick market overview. The S&P 500 is sitting at approximately 5,607, down by about 1.27%. Not far behind, the Dow Jones Industrial Average is trading around 41,753, down roughly 1.16%. Meanwhile, Nasdaq is at about 17,444, down approximately 1.56%. The smaller cap Russell 2000 isn't spared either, holding in at roughly 2,036.827, down by nearly 1.28%. Turning our attention to the cryptocurrency arena, Bitcoin is trading at around 84,180.4, showing a somewhat steeper decline at about 3.46%.
Ethereum, on the other hand, has taken a tougher hit, falling to nearly 1,885.79, down approximately 5.83%.
Now, if you're an investor or trader watching these numbers, you might be asking yourself, what's behind these moves? It seems that the broader market is still grappling with several headwinds related to recent economic data and corporate activities. We can see a trend where investors are reacting swiftly to new information that might affect quarterly growth forecasts and global supply dynamics. It's almost as if the stock market is trying to find its footing on a tightrope, balancing between caution and optimism, and sometimes that can create a rather hectic yet fascinating spectacle.
Let's take a deeper dive into some of the major market trends. There's been a lot of chatter in the economic corridors following the release from the Atlanta Fed GDP Now. Market expectations have shifted as the nowcast for first quarter GDP growth dropped significantly from negative 1.8% to negative 2.8%. While that news stings, it's worth noting that the gold-adjusted model is showing a much milder decline of just negative 0.5%, suggesting that there may be underlying resilience in certain parts of the economy. When market sentiment takes a hit like this, there's invariably a flurry of repositioning across sectors. Many investors are now questioning whether we're simply seeing a short-term uptick in volatility or if this is a sign of deeper, more structural challenges ahead.
In the midst of that, the aerospace sector is also facing its own set of challenges. The Safran Collins aerospace deal is now under deeper scrutiny thanks to a UK competition probe. This is a reminder that even if corporate fundamentals are strong, regulatory hurdles can always throw a wrench into the works. It's almost like planning a road trip, only to find out midway that your GPS has decided to reroute you through a maze of red tape.
Speaking of major corporate moves, Intel just closed the sale of its memory business to South Korea's SK hynix for approximately $1.9 billion. That's a massive deal that not only reshuffles the competitive landscape in the semiconductor industry, but also raises questions about future consolidation trends. Is this just the beginning of a trend, or are we likely to see more traditional tech giants making moves to streamline their operations? It's definitely something to keep an eye on.
On the commodities and resource front, there's been some intriguing international activity as well. Reports indicate that Indian state firms are seeking a 20% stake in Chilean miner SQM's lithium projects in Australia. Lithium, as we all well know, is the lifeblood of the renewable energy revolution, powering everything from electric vehicles to our ever-growing battery storage systems. A more diversified investment in lithium could have far-reaching implications for both the renewable energy sector and global supply chains.
Over in the steel and manufacturing sectors, Nippon Steel is reportedly pitching billions more in additional investments to revive its deal with U.S. Steel. This move is significant as it highlights the ongoing bets being placed on revitalizing American manufacturing and infrastructure. There's something rather exciting about seeing companies commit to large-scale investments, almost as if they're placing a long, deliberate bet on a comeback. Could this be an early indicator of reshoring trends taking root once again?
In the world of mergers and acquisitions, there's been plenty of noise as well. Braze is set to acquire OfferFit in a cash and stock deal worth approximately $325 million. Following the announcement, Braze's shares saw an uptick as investors responded positively to the prospect of strategic synergies and growth opportunities. In another interesting development, Accolade stockholders have just approved a merger between Accolade and Transparent. This decision, confirmed at their special meeting held earlier today, marks a notable consolidation that has the potential to reshape the competitive dynamics within the healthcare space.
Meanwhile, retail and consumer sectors are experiencing their own shakeups. WH Smith has sold its UK high street business for approximately £76 million, a move that underscores the shifting sands in traditional retail amidst the ever-accelerating digital transformation. Not to be outdone, Levi Strauss is reportedly in talks to sell its iconic Dockers brand to Marquee. This has certainly piqued the interest of market watchers given how brand evolution and creative repositioning continue to drive consolidation strategies within the consumer sector.
Furthermore, in the energy space, Sitka Power is gearing up to acquire Senex Renewable Energy at a price of approximately $2.40 per share. This deal is part of a broader trend where energy companies are increasingly aligning themselves with the renewable revolution, aiming to create a more diversified portfolio that can weather the fluctuations of the traditional energy markets.
That brings us to the detailed sector analysis, where I'd like to break down some of the key implications for tech, energy, and finance. In the tech sector, there's no shortage of dynamic activity. The Intel deal is a prime example of how legacy semiconductor firms are adapting to an ever-evolving global market. The consolidation of memory businesses under SK hynix's expansive umbrella could lead to a more competitive landscape where efficiency and scale of operations become of paramount importance. Additionally, Braze's move to acquire OfferFit highlights a broader trend where companies are actively seeking to integrate complementary services to bolster their technological offerings. And then there's the talking point around Levi Strauss contemplating divesting its Dockers line, a strategic decision that could very well reshape how legacy consumer brands evolve in an increasingly tech-centric market environment.
It's almost like watching a high-stakes chess game, where every move could alter the fabric of the industry.
In the energy sector, the acquisition activities and investments are reflective of a much larger narrative, the shift towards sustainable and renewable sources of power. Sitka Power's bid for Hynix Renewable Energy is not just about expanding market share. It's indicative of a more profound evolution where companies are now aligning themselves with a greener future. Add to that the global appetite for lithium, as seen with the Indian state firm's stake in SQM's projects, and you have evidence of a broad-based, multinational reorderings of priorities. It makes one wonder if the energy matrices of tomorrow will be built not on fossil fuels, but on the very innovations that power our electronic devices and electric vehicles.
Turning our gaze to the finance sector, the recent GDP Now update released by the Atlanta Fed is a cause for concern as well as an opportunity for recalibration. The steep downgrade in first quarter GDP expectations from negative 1.8% to negative 2.8% suggests that the economic engine has hit some headwinds. But what's particularly interesting is the muted decline from the gold-adjusted model, which paints a slightly more hopeful picture. It's a fascinating juxtaposition that underscores the inherent complexity of the economic landscape today. As investors, we're constantly asked to reconcile these divergent signals, a task that's never been more challenging in today's rapidly evolving and seemingly unpredictable environment.
Beyond these sectors, the global market implications cannot be ignored. When deals of such scale and cross-border overlaps occur, it sets off ripples that can be felt across continents. The international nature of the Intel and Sitka Power deals, combined with the regulatory uncertainties surrounding the Safran Collins Aerospace deal, signals a broader trend. Globalization is here to stay, but with it comes increased regulatory scrutiny and the potential for geopolitical frictions. Emerging markets, too, are watching these developments closely, as their own policies and trade strategies might need recalibration to stay in sync with the evolving global economic architecture.
Expert insights and predictions have us speculating on whether these market corrections are temporary jitters or harbingers of a longer-term restructuring at play. Some analysts believe that the decline in GDP expectations might spur central banks to adopt a more accommodative stance, while others warn of the risks of inadvertently fueling asset bubbles through excessive monetary easing. It's a delicate balance akin to walking a tightrope in a windstorm between stimulating growth and preventing the formation of unsustainable market imbalances.
If you've been following these stories, you might also have noticed the recurring theme of consolidation throughout the sector movements. Take the merger between Accolade and Transparent, for example. It's not just about combining assets, but also about pooling expertise and creating a stronger, compatible entity that can weather future shocks. These moves are a clear signal that in today's tightly interconnected and fast-paced business environment, scale and integration are not just beneficial, they're imperative for survival.
And, of course, there's always room for a little humor along the way. It reminds me of a market joke I heard recently. Why did the investor bring a ladder to the market? Because he heard the stocks were on an upward climb. While it might bring a smile during these turbulent times, it also underscores the never-ending quest for upward momentum amidst uncertainty.
So what does this mean for you as an investor or trader? The key takeaway is that while the market is undoubtedly experiencing headwinds, from broad-based index declines to sector-specific challenges, the underlying issues are multifaceted. Whether it's the granular adjustments in GDP expectations, the strategic corporate moves in tech and retail, or the heavy-hitting deals in energy and semiconductors, there are layers upon layers of signals to decipher. The question then becomes, is this period a mere blip on the radar, or are we witnessing the early signs of a more structural transformation in the financial landscape?
Let's explore a few of these points further. Consider the ramifications of the Intel sale. This billion-dollar deal not only shifts the competitive battlefield in semiconductors, but also forces us to ponder, will other major tech players follow suit and offload segments that don't align with their core focus? And if they do, how will that reshuffle affect supply chains and global tech innovation? It's like watching a well-planned game of chess. Every move has consequences, and every shift in strategy could open up new avenues or close off promising opportunities.
In the energy sector, Sitka Power's acquisition of Hynix Renewable Energy is another fascinating development. This move, priced at nearly $2.40 per share, is more than just another M&A headline. It's a clear sign that the energy sector is pivoting rapidly towards renewables, driven by both investor demand and global climate imperatives. It compels us to ask, as renewable energy investments accelerate, will traditional energy stocks continue to face pressure, or will they adapt and transform into hybrid models that can harness both old and new paradigms? The interplay between conventional energy mechanisms and transformative renewable strategies is a dynamic to watch in the months and years ahead.
And what about the sector reshuffle in consumer goods? Levi Strauss Tailoring talks about the sale of its Dockers brand might seem like a niche move, but it is emblematic of broader shifts in consumer preferences and brand positioning. In an era where digital transformation is reshaping retail, legacy brands are under immense pressure to reinvent themselves or risk obsolescence. Perhaps this is a wake-up call that even the most storied names in retail must adapt to survive. While some might joke that the only thing constant in retail is change, it brings to light a sobering reality. Adaptability is the only way forward in a world where the pace of evolution is nothing short of breathtaking.
Now, as we bring together all these insights, let's consider the broader implications for both global markets and individual investors. Regulatory changes, international geopolitical tensions, and rapid technological advancements are converging at a time when the economic landscape is more interconnected than ever. This means that news in one corner of the globe can incentivize rapid responses in another, whether it's an unexpected GDP revision in the United States, a nimble move by a tech giant in Asia, or an aggressive acquisition in the energy sector in North America. The interconnected nature of modern finance is both exhilarating and challenging. It forces us, as investors, to adopt a holistic view, recognizing that no market or sector exists in isolation.
As we look towards the future, expert analysts are divided. Some believe that these short-term declines in major indexes are simply market overreactions, a temporary correction in an otherwise robust economic cycle. Others argue that the convergence of several negative indicators, from the GDP nowcast to the regulatory hurdles in Europe, could herald a more protracted period of market adjustment. What remains clear, however, is that vigilance and agility will be key. For those of us managing portfolios or trading on daily movements, the ability to parse out these complex signals is crucial. The question remains, are you positioned to capitalize on short-term volatility while also keeping an eye on the longer-term structural shifts that may be unfolding before our very eyes?
Now let's have a closer look at some of the specific stories making headlines and their potential impact. The Atlanta Fed's revised GDP nowcast is perhaps one of the most significant economic signals coming from Washington. A downgrade to negative 2.8% signals caution for the coming quarter, particularly when juxtaposed with previous expectations. Yet, the gold-adjusted model's relatively lighter decline of negative 0.5% offers a glimmer of hope for underlying economic resilience. Could this disparity be a case of differing methodologies, or does it highlight the strengths of certain sectors that might outperform in turbulent periods? It's a nuanced scenario that invites further analysis and perhaps even a rethinking of economic forecasting techniques.
Similarly, the Safran Collins Aerospace deal's entanglement in a deeper UK competition probe is a stark reminder of the complexities facing cross-border mergers and acquisitions. Regulators are clearly on high alert when it comes to preserving fair competition, and such scrutiny can derail even the most promising deals. This raises an interesting point for corporate strategists. In planning cross-border transactions, are companies adequately accounting for regulatory uncertainties? And if not, what might be the fallout for companies whose strategic plans are thrown off course by an unexpected regulatory intervention?
The tech sector, as we mentioned earlier, is witnessing significant realignment. Intel's whopping $1.9 billion sale of its memory business to South Korea's SK hynix might be seen as a harbinger of similar moves among other legacy tech companies trying to streamline and focus on core competencies. As more of these transactions come to light, will we perhaps see a new wave of consolidation in the semiconductor arena? And for the companies that remain, how will they leverage these market shifts to their advantage? The dynamics of supply chain management, production capacities, and technological innovation are all in flux, and the only constant seems to be change.
On the commodity side, the push by Indian state firms to secure a 20% stake in Chilean miner SQM's lithium projects in Australia is a development that merits close attention. Lithium is not just another commodity. It's central to the future of energy storage, electric vehicles, and, broadly speaking, the clean energy revolution. Given the rising global demand for lithium, if major state players start making moves in this space, private investors might well need to reconsider their positions. Is this an early sign that more institutional money will be poured into the lithium market? And if so, how will that impact prices and future supply trends?
Another noteworthy story is Nippon Steel's pitch for additional billions in investments to revive its deal with U.S. Steel. This isn't just about merging companies, it's about revitalizing an entire industry. The steel sector is often seen as a bellwether for economic health, tied as it is to construction, manufacturing, and infrastructure. Large-scale investments in this sector could be seen as bets on the future rise of manufacturing and could even have positive ripple effects on employment and regional economies. But they also come with risks. Unanticipated global supply chain issues or shifts in global demand could quickly turn optimism into caution. As always, the devil is in the details.
Then we have Braze's agreement to acquire OfferFit for $325 million in a blend of cash and stock, which has already led to an increase in Braze's share price. The market seems to be reacting to the prospects of greater strategic integration and the synergies that such a deal could yield. This move not only strengthens Braze's market position, but also serves as a case study in how companies are looking beyond organic growth methods towards smart acquisitions that immediately expand their capabilities.
Closely related is the news from Accolade and Transcarent. Following their recent merger vote approved by Accolade stockholders, the combined entity is expected to emerge as a more formidable player in the healthcare sector. This merger underscores how, in times of economic and market uncertainty, companies find strength in unity. It's an intriguing development that forces us to consider, might we see a wave of similar consolidations in healthcare and other industries where fragmentation currently exists?
Lastly, as mentioned earlier, retail and consumer sectors are experiencing notable changes. W.H. Smith's sale of its UK high street business for £76 million speaks volumes about the shifts in retail, where digital transformation and changing consumer habits have forced traditional players to rethink their strategies. Meanwhile, Levi Strauss, in talks to sell its Dockers brand, is a vivid reminder that even the most iconic brands must constantly evolve to survive. It begs the question, in an era of digital dominance, how can legacy brands reinvent themselves without losing their heritage?
Taking a step back to consider these developments, it's clear that the interplay between these diverse sectors is anything but isolated. The actions in one segment resonate with implications in others, creating a tapestry of opportunities and challenges that stretch across the global market. Whether we're talking about a multi-billion-dollar tech deal, a shift in consumer retail strategy, or the profound impact of international regulatory action, every story is a piece of a larger puzzle that investors need to assemble.
From a global market perspective, the trends we're seeing hint at a rebalancing act. There's an increasing focus on sustainability, whether it's through renewable energy initiatives or through investments in critical commodities like lithium. At the same time, traditional sectors are not standing still. They're undergoing transformations that speak to a fundamental reshaping of how industries operate on a global scale. In today's interconnected world, market shocks in one region can ripple across continents, creating both risks and opportunities for those who are agile enough to navigate these waters.
In offering some expert insights and predictions, I would say that the short-term volatility we're witnessing is part and parcel of the market's natural cycle, yet amid these corrections lies opportunity. Investors who can maintain a steady hand during these periods, one who understands that market turbulence often precedes a period of renewed growth, might well benefit from the eventual upswing. One interesting thought to ponder: do these short-term disruptions provide a sort of reset button for overvalued segments of the market? And if so, how might that influence our long-term investment strategies?
As we wrap up this conversation, here are a few key takeaways to consider today. First, while the numbers from the major indexes and cryptocurrencies show a clear downward trend, there are nuanced stories behind those figures. The Atlanta Fed GDP Now update, for instance, highlights a potential slowdown in Q1 growth, yet alternative measures signal a degree of underlying resilience. Second, in the corporate world, major deals, whether it's Intel's billion-dollar sale or strategic mergers in the healthcare sector, are reshaping the competitive landscape and signaling long-term shifts in how companies operate. Third, sector-specific developments, from renewable energy acquisitions to retail consolidations, are charting a path that reflects both a response to current challenges and an anticipatory move toward future opportunities.
Of course, this conversation wouldn't be complete without acknowledging the inherent unpredictability of the markets. It's a bit like trying to predict the punchline of a well-crafted joke. Even when you see the setup, the final twist can catch you off guard. So here's one to lighten the mood. Why did the trader bring a map to work? Because he was trying to find his way through all these unexpected market turns. While humor aside, the serious underlying message is the importance of staying informed, adaptable, and ever curious about the forces at play.
Before we sign off today, I'd like to leave you with a few thought-provoking questions. How do you assess your risk appetite in the face of such multifaceted market signals? Are you positioning yourself to take advantage of short-term volatility, or are you more focused on the long-term fundamental shifts that are reshaping our global economy? And given the accelerating pace of consolidation across industries, how do you think emerging technologies and regulatory changes might redefine traditional investment paradigms over the next few years? These questions are crucial for anyone who aims to navigate the turbulent yet fascinating world of finance today.
As ever, thank you for joining me for this deep dive into the markets this morning. Remember, whether you're tracking global indices, rebalancing your portfolio in the tech space, or exploring new opportunities in renewable energy, Pantheon AI is here as your trusted information co-pilot, helping you parse through the noise to find the signals that matter. I invite you to come back for the next episode tomorrow, and as always, if you have questions or need deeper insights, you can always reach out and ask questions to our AI co-pilot.
Until then, keep your mind sharp, stay inquisitive, and remember, learning shouldn't feel like a full-time job. Have a great day, and take care out there in the markets.